Step 1. We seek to identify the key value drivers of the business. In this case, we look at St James Place, a UK-based wealth manager, which is currently a top 10 holding in our global funds. Now, for a wealth manager, the key value driver is typically growth in funds under management, or FUM as our industry tends to call it. We can then tree out the various drivers of FUM growth for St James. As you can see, FUM growth is a function of new inflows, as well as how the existing FUM evolves. How the existing FUM evolves is a function of average market returns over time and any systematic drawdowns that need to occur. Now, inflows are a function of advisor growth and the productivity of each advisor. Our second step is then to reverse engineer what the current stock price of about £11 per share is telling us about what the market is expecting for these value drivers. To us, a stock price is nothing more than a numerical representation of future expectations for the key value drivers of the business. Now, shown on the chart by these blue bubbles, these growth rates are our best estimates of what the market is expecting at £11 per share. Step 3, we then evaluate the reasonableness or otherwise of these expectations. Now, if all of the expectations look pretty reasonable, then there is no investment opportunity here. And this is by definition. If you buy a stock that has a reasonable set of expectations built into its price, then your expectation should be for zero outperformance of the broader market. We believe there is one dimension along which the market is being too conservative in its expectations for St James, and that's advisor growth. So as shown on the chart, we believe the market is currently pricing in 2% growth in advisors. But we believe the business will achieve as much as 8% growth. Now, why is that? Well, recent growth in the number of practices on the platform has been more than 5%, and then the growth in the average number of advisors per practice has also been growing at 3%. So 5 plus 3% gives us 8% expected growth in advisors. Said another way, we believe the market implied expectations for advisor growth at St James are unreasonably conservative. And if, and only if, the market implied expectations built into a stock's price are unreasonably conservative, then we have an investment opportunity. Finally, step 4, we map the expectations of advisor growth on the horizontal axis to the value per share of St James on the vertical axis. Now, as you can see, if advisor growth is 2% as expected by the market, then the stock is worth £11. But if advisor growth is closer to 8% as we expect, then the stock is worth around £18. So that's how we do it in 4 simple steps. Every stock that we own has gone through a similar process. Upon identifying a high-quality business, we identify its key value drivers, we reverse engineer the expectations that are implied by the current share price, and then we identify where and why we have a different view, and we map those expectations to the value per share of the business. This is how we have generated significant outperformance to date, and this is why we believe we can generate outperformance on a sustainable basis in the future.